So where are we right now with crude in the U.S.? We want to talk more about this and how it fits into all the portfolio positioning you might want to do. Let's bring in Warren Pies, co-founder of 314 Research. Warren, let's start with oil. I know you do plenty of work on that. What's the read on it? I mean, it acts like a market that's oversupplied. Should we be taking away anything about global demand or the economy? And where does it go from here?
Yeah, thank you for having me. I am proudly not one of the analysts that go to the OPEC meetings. Everything I do is based on data and kind of modeling. So with that kind of preamble, I think everyone in the oil business is used to this week of the year, Thanksgiving, a lot of nervousness. We've had bad meetings, horrible meetings back to 2014, all involving OPEC and unable to get on the same page. And I think we're at a similar kind of junction right now. So we have all this OPEC supply that's been held off the market now for most of the year, for better part of this year. And it's something we've been thinking about for a while at 314 is how's this production come back, and I think that's where we're in the middle of that debate. And so that's kind of the overhang that's weighing on the market right now. But from our perspective, what's really driven crude oil prices through the whole year has been speculative positioning. So every time we get to an extreme in speculative positioning, it's paid to go the other direction. We saw that in early July. We were long oil in early July, and we got out of that position in mid-late September. And it was just based off of speculative positioning and going too far in one direction. So right now, I think we're in the process of working that off. November's a notoriously weak month for oil because you're coming on the back of Mexico hedging all of their production. So banks and dealers have a tendency to sell futures to delta hedge all the puts they wrote to Mexico. So we're in a trapdoor. It happens almost every year. We're out of the market right now. And I think for the most part, I think OPEC's going to come to an agreement here. But I'm not sure that it's going to be anything that can save that speculative rotation that we're in the middle of right now.
So whatever the dynamics driving prices to where they are right now, it does seem as if it's helpful to, the general, slow down but not too slow story, the soft landing, the fact that you can refresh consumer buying power, take the edge off of inflation expectations, perhaps bond yields coming lower. So, I mean, is it fully benign or can we find something to worry about in all this?
Yeah, it's not, in my opinion, demand driven. So we've had non-OPEC supply ramp up. We've had OPEC cheating, and this is why the Saudis they've carried the water this entire cut, and they're getting frustrated, understandably. So you've had Russia cheating, Iraqi production's coming back as there was a big pipeline outage there that's coming. So that's allowing Iraqi production to come back. UAE is constantly wanting to get more production on the market. All these small producers that Brian was talking about. I mean, it's a supply story. It's not a demand story. So unfortunately, I don't think you can read recession from the drop in oil price. No. And so ultimately it's a good thing for consumers and for markets.
And then where does it leave you with regard to, stocks as we've had this rally in the indexes? We're not too far from the highs for the year. It feels as if we're in this period where, the market can deal with the idea that the Fed is done without necessarily getting those cuts as yields come down. So what's the opportunity? What are you looking out for?
Yeah, we're in a Fed pause. So this is the period that follows the last Fed hike in a cycle. And traditionally, if you composite all these things together, it lasts 8 months. And this is a period of hope and optimism regarding a soft landing. They generally, it lasts 8 months. That would put the first Fed cut in March. And stocks generally rally every case except for one. Bonds have rallied every Fed pause on record. And so this is a time where all assets are rally. And but at the same time, you have to look at what's happening under the economic surface. I do think the soft landing evidence is building, but unfortunately, on the other side of that, markets have already kind of fully priced that in. I think stocks have fully priced in a soft landing. So any disappointment from the Fed, any disappointment on interest rate policy, you're seeing 33% chance of a Fed cut in the March meeting already. I think that's overly optimistic. So there's a setup for a disappointment. You have the economic reality on one hand competing with what markets are pricing in on the other. And I think the markets continually get ahead of themselves in this cycle. And I think we're seeing that again. So our positioning, just to be really clear, is we've been riding bonds over stocks. I think there are more paths to victory with the bond position here versus the stock position. And that's been our position really since October 19th when yields on the 10-year hit 5%.